welcome back to this afternoon. We now have a session on the client perspective, and a number of presentations have referenced the significant growth in client demand for ESG investing during the day. Fiona spoke about it in the first session this morning. Julie referenced it just now in her workshop, and I think there were probably other references in the other workshops that I wasn't able to attend. So we're delighted to be able to welcome a number of leading clients in this space today, and also an advisor to the client. And actually, just starting with Tomi Nummela. Tomi is the Senior Consultant for Responsible Investment at Mercer. Tomi is on the far left-hand side. Joined Mercer from the PRI and went to PRI from the University of Cambridge, where he was also doing work on responsible investing, and went to Cambridge after about a decade in investment banking. And then Edward Mason is the head of responsible investment at the Church Commissioners for England. As well as that, he's also part of the UK CIF Policy Committee and on the SRI Committee for Oxford. And then Faith Ward is the Chief Responsible Investment Officer at Brunel Pension Partnership, but is also co-chair of the Transition Policy Initiative and chair of the Reporting and Assessment Committee for PRI, and a member of the Ethics Investment Working Group for the Church of England. And I think it's fair to say that Faith and Edward are leaders, really, in challenging the investment management sector to really sort of, I was thinking of a polite way to put this, anyhow, to sort of raise its game, pull its socks up on ESG, and also in challenging investee companies to do the same in terms of disclosures and reporting, and actually in terms of their actions. And for instance, Edward was instrumental in the work that was done in the Exxon AGM earlier this year, and Faith has done a great deal of work on putting together an asset management accord which describes some of the expectations that Brunel has of its managers. So while I just retake my seat, I'm going to ask them each to sort of fill in what I missed, and maybe Faith, we could start with you.
Thank you. So just for people that don't know, Brunel Pension Partnership is one of the new asset pools that was generated to manage the assets of the local authority pension fund scheme. So we manage assets, broadly speaking, for the southwest of England, but also for Oxfordshire and Buckinghamshire. So we have about 30 billion of assets under management. We're a organisation that sort of sits in between. Our clients set their strategic asset allocation and their investment policy, and our primary role is to appoint and monitor managers. So hence the reason of keeping and calling managers to account is very much core to what we do, and we embed responsible investment into every single one of those asset classes, into every single one of those portfolios, and expect our managers to do likewise. So yes, there is we'll come up with some tough things and some reflections on the industry. Because we are new, we are actually onboarding asset managers all the time, and actually we reckon we've looked at about 700 to 800 propositions for different investment strategies over the last 18 months. So our awareness, if you like, as to where managers are in the market is probably as highest it'll ever be. We hope not to have to go out and retender everything all over again. So, but yeah, so I hope to bring some insights from there.
Thank you. Edward, what do you need to fill in for the audience?
Sure. Well, thanks very much for having me here, and it's great to see so many in the CFA family so engaged on ESG issues today. So the Church Commissioners run the Church of England Endowment Fund, so that's an 8.2 billion sterling fund. I guess I would say that there are kind of three key things that we're looking for from the asset management industry. So one is obviously ESG incorporation and stewardship. And you know, we've been consistently working on this for kind of several years now. We have a responsible investment framework under which we assess all managers that we are proposing to our trustees. And I presume we can kind of go into this later on in terms of the amount of progress that we're seeing. We're also quite distinctive in the responsible investment world in that we are avowedly ethical investors. We do have a need for investment restrictions, and we look for solutions from investment managers that allow us to reflect our investment restrictions in the strategies that we go into. I think, again, we're seeing an awful lot of progress there. Finally, one of our core expectations is on climate change. We are looking to managers who take climate change into account in how they manage assets. It's by far the biggest issue that we and our stakeholders are concerned about. And fundamentally, we're looking for managers who are seeking to support the implementation of the Paris Agreement. We think that's the best ethical and financial outcome for us and for society.
Great, thank you. Tomi.
Thanks. So, yeah, indeed, it's a very good event. I've been here since the morning. It has a bit of a Glastonbury feeling, so there's like a lot of conversations going on.
It's not something people say about TFA events very often.
I see you're being a bit grumpy about it. Really? Is that what it is turning into? So, yeah, I work for the responsible investment team at Mercer's, and Mercer's obviously been looking at this responsible investment for quite some time. So, PRI has been popping up here several times, so we were actually the consultants called in to help to set up the principles. So we have a long legacy and track record in this space, and obviously climate change is one of the key elements that we look at and work quite a lot on that.
Okay, great. So in terms of rating managers, you may not have looked at 700 to 800 propositions in the last year, but you obviously are looking at the full spectrum of managers and assessing those for your clients and trying to help them decide which managers they should work with. How, in your view, is the investment management community doing, and how has it progressed in the last year?
That's correct. It's not 800. It's 35,000 strategies that we have in our databases at the moment, and 5,000 ESG ratings we have there. So I guess CFA event. So there's got to be a number here. So number will be 80%, and may decide is that a good or bad. But like Professor Dimson, I need to put a little bit of background. So indeed, we've been looking at those ratings for some time. So for 10 years, we've been assigning these ESG ratings. And ESG ratings, they run from 1 to 4. 1 being good. I would characterize that in a way of someone who's got a 1 rating. They really understand what's going on. So they would buy a security based on their conviction. 2 would be someone who would potentially take more sort of risk view, and in a way they might sell a security. And this is very much of a summary of all those methodologies. And 4 is someone we kicked the tires and found the tires empty. So we have those 5,000 ratings there for 10 years. And then if I look back 5 years ago, we had 1s and 2s. We had roughly 10% of 1s and 2s. Now we have about 20% of 1s and 2s. That's a great number. That's double. But at the same time, in this 5 years' time, so what has happened? Everybody's seeing the expansion of ESG. Everybody understands now that Ben started this morning describing how ESG is really important to risk, it's really important to returns, it's really important to reputation. All that has happened. That's beyond doubt. Bank of England is serving ESG, responsible investment, climate change as a main course. All the sensible regulators globally have said that, okay, investors must be looking at ESG factors. So that when you start to think of that, so really 20% are 1s and 2s. So that leaves that 80% of being 3s and 4s. 3s, they have sort of the minimum in place in a way, and this is maybe rough, this may be sort of a rough description of what it means, but something that sort of like unsuspecting prospects may fall for. And 4s, like I say, that's the element that we looked at and kicked the tires, and tires were empty. So 80% of the industry is there. 80% is roughly at the moment. We've also heard during the day that this is the only growth game in town. So where the money's flowing, where the assets are flowing, is ESG. So 80% are quite happily in that sort of danger in their own business going forward. They do not understand ESG well enough. 80%, I don't know, maybe it's rough to say, but almost danger in the planet. Quite happy to do that. So it's not necessarily as sort of rosy picture as the morning has built. So obviously all of us here, we are 1s and 2s, and even beyond 1s and 2s, and that's clearly something. But I guess we all need to look and sort of figure out so where we are on that spectrum. So do we understand? So what are the sort of the behavioral biases that we have Do we understand? Is this a whole day? Did it feel like there was something that didn't totally click? I didn't get it. I can't really make a decision on that. Is that something that we would be looking at? Because every industry is as good as the individuals within it. And obviously CFA is a great place to sort of like bring the bar up.
And Faith, does that sort of 80% not really there yet, 20% there, does that, is that your perception of the marketplace? So in the 700 to 800, is there a, sort of a fifth of that you think actually, that's interesting and those managers are pretty good, or is it a smaller number than that, or is it a larger number? And so are you being approached by people who are actually sort of think, crikey, we're talking to Brunel, we better really, put a great presentation together because they know their stuff and they're leading in this field? Or so what perception do you have of the management community?
I haven't really thought of it in percentage terms, but it's probably about right. I'd say that we'd seen quite significant improvement, I would say, on even understanding the questions we were asking, which is a good start, in terms of, in terms of asking what the sort of integration of these issues are, and even using the right letters. We're talking about environmental, social and governance issues in integration, but actually it doesn't actually just finish there. ESG is, I do actually have a problem with the terminology. It's a little bit constraining. We actually mean anything to do with political risk is valid within there, business strategy, anything perhaps that has traditionally fallen outside of your balance sheet and things like that. So a lot of these things don't have numbers on them, which obviously make it for your community a bit more of a sort of a bit of a culture shock, because you're trying to quantify particularly social issues that are really quite hard to perhaps put sort of quantitative or to calibrate kind of where things are at. But I think there is much greater understanding as to what we're talking about, so we're having a much more intelligent conversation with the community at large. Where I think I struggle is to see the quality when you scratch beneath that surface. So we might get some pretty good slick responses to start with, but when we go through the process, it takes us usually about 9 months to do a whole tender, which is why we've got one coming out more or less or has been about every 6 to 8 weeks. We've had another tender issued out, hence the number of manager strategies that we've reviewed. When you actually start to scratch beneath that surface and actually look at the level of integration, and do they really get it, that we mean more than just buying MSCI or Sustainalytics and going, oh, we've looked at that's fine. No, how is it impacting on your discounted cash flow? How is it, impacting on what you're actually making as an investment decision? That's when the differential comes out. And I'd say there still is only a very small number of managers that we get to select from that are in that space. That's not to say that we won't select a manager that still hasn't, particularly there are strategies, particularly in the quant or value space, where perhaps this is more of an emerging issue, it's a bit more challenging. And we have appointed managers for whom this hasn't been an aspect, but they have been very honest in their submissions to us, but they've been very open to where they see the opportunity to work with Brunel to develop this, and which, say, in more emerging say asset class and things like that, then we're open to work with managers. So it isn't just about, but there isn't, partly we have to, because there just isn't the managers in some of the spaces to just go and select from. It's not a case of just walking going, oh, I'll have one of those, please. They just don't exist.
Right. And Ed, were you finding the same thing? What do you find when you scratch the surface? And what sort of questions are you asking to try to figure out who you're actually talking to and whether they have that capacity?
Yeah. I guess we work with a relatively small number of managers, and we tend to stick with managers for quite a while. So, our approach is quite relational. So there are minimum standards that managers need to meet when we take them on board. But we look to work with them to kind of improve their kind of exploration of ESG materiality with their investment strategy. And I think. It sounds kind of quite similar to what you're doing at Brunel, Faith. And I think that's an important role, actually, that asset owners can play is to kind of is to work with managers and to kind of to move on players that kind of aren't at a high level, rather than just kind of selecting those that are performing well already. And I think I've been quite encouraged in the last year or two by kind of managers in areas where we haven't seen good penetration of ESG, really kind of starting to sort of grapple with some of the issues. I'm talking about like hedge funds or venture capital. We are starting to see managers in those areas kind of think about it in a more thoughtful way and what it means for them. But there are definitely still frustrations as well. I mean, I think, I get frustrated if, there are managers who hold companies, say, in the listed equity space that, we're looking at them through an ESG lens or an ethical lens. And, we can see that there are problems there, whether it's a mining company with kind of, social issues, or, an oil and gas company with climate change. And, the manager just isn't really kind of on top of these kind of ESG fundamentals. And so I think as Faith said, that can happen. I mean, particularly in the value space, I still can find that an issue.
How do you figure out that they're not really on top of it? I mean, is it just having a long meeting and letting them sort of talk it through, and getting that the fact that they haven't done their homework and they don't know something that they should know, or that they don't integrate the thing that they know about properly into their process, or is it a mix of?
I mean, you can find out from a pretty short interaction, actually,
right,
as to whether a manager kind of understands ESG.
So this is sort of speed dating.
And I think
ESG
it's just kind of, you can just see how they're thinking. And, they may be, looking at it purely on a kind of balance sheet basis, and that kind of, the most kind of ESG stuff they've done is kind of looking at the governance of the company. But, it could be a company that's just killed 6 people in one we were looking at recently, in a derailment incident in China. Plus it had other incidents recently. So, that awareness can still be lacking. I think the other frustration can be on climate change as well, where, we're looking for managers to ask for public policy that implements the Paris Agreement. That is not a very kind of demanding ask, really. And we've got, investors with, I can't remember, like $35 trillion of assets, I think, that have signed up to the current global investor statement on climate change. But I mean, there are still managers that we go to who sort of, who think that that's not for them. And some of the world's biggest asset managers still think that's not for them. And not all managers are using their votes effectively on the issues that we care about as well. So, there's a lot of progress, but there's still a long way to go.
If I can just come in, one of the things I want to be quite clear about from a sort of responsible investment perspective is, whilst there might be egregious issues where we might be challenged as to why we hold the company, particularly in certain portfolios, it isn't about not holding them, it's about your awareness of the risk in holding them. Yeah. So we're not saying that you can't hold these more challenged companies. Often some of the more interesting portfolios are those where, and Elroy Dimon was talking about these before, about whether you can actually work with a company to turn it around and actually see, and that's where often you can deliver.
It's what you're doing about it.
Yeah, that you can actually deliver some of the best financial returns, and you've actually made an impact in improving the governance, or you've improved the actual efficiency, the carbon intensity of that business, because you've made them aware of their emissions, but perhaps they haven't been aware of before. So I want to be really quite clear that it's not about us not owning things, it's about the awareness of those risks that might destroy the investment case that you've created, things that might come in left field, and these are these sort of, well, traditionally were left field. I think they're kind of becoming more central now, but that's where we're coming from.
Yeah. Tomi, sorry.
Yeah, that's one of my favorite hobbies, giving trustees tricky questions and then wait for that awkward silence when the manager comes to the room.
What is one of the tricky questions? Just that, because these people have all paid good time, money, and I'm sure they'd like to know what's the worst question that they could be facing.
Simple questions. They don't need to be that. So I don't know. How do you know your carbon footprints? Everybody's talking about carbon footprinting. So do they know their potential emissions from their emissions? Where are the green revenues?
Very good.
For one that we've used quite recently, and I'll put it out there quite openly as part of our tender, and this goes to the greenwashing question that is becoming a very big problem within the industry. Has this product been called anything before, and why did you change the name?
How often do you get a sort of a long pause before an answer?
A lot.
A lot, yeah. And Tomi, Edward was talking about voting.
Yeah.
In terms of your ratings, how do you break that up? So what are the sort of the different pillars within that? And is stewardship or stewardship voting one of those? And do you see that managers are progressing in some areas and less so in others, or not?
That's right. And obviously, for example, there's been a lot of discussion about passive management here today, and there in particular, engagement is a huge issue. Engagement voting, active ownership is a huge issue there. And there has more weight there, because that seems to be this, or is this the way to have a better ESG processes, unless you go into tilting or building portfolios somehow differently. But mainly what I was sort of alluding to there, the ESG ones, there's a sort of idea generation. And obviously in the passive land, you can't have that much idea generation relating to ESG. So in an active land, it's idea generation. It's how the portfolio construction goes on. It's about the general sort of the teams, how the expertise being built, how the organization itself supports right from the top. So understanding that is the ESG team something a bit of irrelevant there, or is it a feature that is well supported by the full management? So obviously these sort of managers will have good engagement likely because they know that from the engagement they'll be able to take something back into their analysis.
And then when you're, in terms of your managers' performance around using their votes and the stewardship and engagement, do you see progress, and where would you like to see managers sort of progress further? Where can they make the greatest improvement?
So on voting, actually, we carry the voting rights for listed equity strategies because we think it's important for us to express, our view as an asset owner, and also to vote kind of consistently, where you have the same holding in multiple portfolios. In terms of engagement, we are always encouraging our managers to do more and to do it if they're not doing it. And I think we're definitely seeing more happen in this area. But as I say, there are certain kind of strategies for whom it's kind of less natural. But no, definitely seeing progress at the moment.
And in fixed income as well.
Yeah, although we do less in that space as an endowment, actually. Yeah.
And Faith, in terms of your view, in terms of voting and stewardship, in terms of your satisfaction with managers and the reporting back to you, I guess.
I think that's where the weakness is, particularly, and I think, but managers acknowledge that. So I think we've seen a very open dialogue on recognising that that they need to report better to us as the client, and then because we're getting an awful lot of pressure. If you can see from the upswell of activity from anything from Extinction Rebellion to the single-use plastics to, the demands on me to be able to explain what we invest in and what we're doing about these issues is phenomenal. And therefore, as I appoint managers who make those decisions, I need the help from that community to report the stories and to be able to convert that. I think the challenge we have as an industry more broadly is how to communicate that in ways that our underlying beneficiaries can actually get to grasp with. And I think for that, I would use the Sustainable Development Goals. That is one of the reasons they've been created, is to create a common language, a common dialogue, so that if we're talking about life underwater or climate change or sustainable cities, that there is that sort of common language set. Now, not all of those are going to resonate as investment themes or risks. Some of them are more challenging in that space. But I think to be able to use that as a framework for communication back out to beneficiaries is the direction of travel. But it's not, you don't necessarily have to try and map everything to it. I think that's a bit artificial, but it's about using that language consistently so we can make it relate to. And
is that what part of better reporting for you looks like, or is that more about sort of reporting back to you faster in more depth and with a narrative? I'm just trying to get a sense of what...
I think it's to enable me to do that. So I think there's a job of work still to be done for us to understand kind of what the end beneficiary actually wants. Often we get feedback, they do like infographics, they like the conversion of data, so how many equivalent to journeys, of car journeys or of houses heated and things like that. So they need to convert it to something they can actually relate to. If we're talking about kind of CO2 emissions means pretty meaningless to them, so I need to convert it into something that they understand, but at the very least I need the CO2 emissions from the manager, even if I'm doing then some of the conversions in the language, and they need to understand that's why I'm asking, is because I'm trying to make sense of it for the purposes of the end beneficiary. They have a huge appetite for interest in this space. We used to have, there is a whole range of issues from what we're doing around sort of sexual harassment and employee rights, through to climate change, single-use plastics, water use, taxation policies. So we do get asked the beneficiaries do ask quite challenging questions on a fairly regular basis.
What proportion of beneficiaries though? Because is it still a small proportion of the beneficiaries who ask a lot of questions, or are you seeing that the sort of a longer tail now through the beneficiary group with more people being interested?
We get a lot of it from the actual pension committee members, so I'd say that they're coming because we have obviously 10 underlying pension committees and pensions boards as well, so a lot of it's coming through them. But no, I think the range of issues, and just numerically a lot more. Right. Some of them are stimulated through NGO activity, and they're supported in doing that, and obviously there are other stakeholders who are also asking us questions as well. So.
Sorry, Tomi, you wanted to jump in just for a second.
Yeah, it was on that engagement and voting. So it sounded as if, because I'm a bit of a glass half empty Finn, so it sounded as if we gave a sort of like too positive image of that. So I'm just to sort of like everybody here that, okay, when you go back to your organizations, challenge this. So have you voted along the lines of Edward, for example, lately? Have your organisation done that? Have you put resolutions out there? So how many people you have on engagements? Do they cover your assets? Ask these questions and look through your policies and think through really, is this engagement, is it going to work, or is it something that's a bit of a glossy? And I think at the same time, for example, the Shareholder Rights Directive is at the moment asking all the asset owners to take more ownership of their engagement and voting. So they will be asking these questions. So again, something that will be asked from you next 18 months, 12 months, more and more. So just visit those, that engagement that your organisation does.
And Edward, you wanted to jump in?
Yeah, I just wanted to come in on reporting actually, because I've been in responsible investment for 10 years now, and I must admit it's one of the areas where I'm surprised things haven't moved faster really. I think asset owners have been asking for better reporting for a long time now, and we're getting regular reporting from managers. We're getting quarterly reports. Just include ESG in those. How ESG is affected by sell decisions, what you're doing on kind of stewardship issues, what engagement you're doing. We're still not seeing enough of that, and I think that that should be an easy issue to solve. So I would really press on that one, because as Faith says, we're actually requiring more sophisticated reporting now as well, because our beneficiaries are looking at the next level, which is the impact of our investments. We want to be able to communicate the impact. We have certain kind of target areas of impact that we are particularly interested in understanding in our portfolios. So yes, we want to understand carbon emissions in all areas of our portfolios. So in private equity just as much as listed equity, or in forestry, or the range of asset classes that we invest in. We want to understand kind of where revenues are being generated from our impact themes. So let's get the basic reporting right, and then kind of start to find the solutions to these more sophisticated reporting needs as well.
So one of the sophisticated or potentially sophisticated reporting needs that we were talking about a little bit this morning was whether or not managers should be more actively involved in policy and advocacy work. And I guess my question would be, if we're not even getting reporting around engagement right, are we asking too much of managers to expect them to be involved in sort of policy and advocacy work and to be able to report back to you meaningfully on that? Or do you think we should just encourage them to do it anyhow and start getting involved there?
I think doing it is more important than telling me about it, probably as a first step. If I could just highlight something that I'm particularly upset about at the moment, is the FCA published its response to its discussion paper on climate change last week. There are 59,000 FCA regulated firms. Do we know how many people actually bothered to respond to that discussion paper on climate change? 73. And I wrote and co-wrote 2 of those, so there's 71 left to go, and even half of those were civil society. They were like the Grantham Institute, they were, I think, Share Action submit a response. So actually, FCA regulated firms responding to their own regulators' request for support on what it should do about climate, that is appalling. That is absolutely appalling. So that's my call. If they ask you for help in the future, please respond, because that really, really annoyed me. I'll be honest with you, really, really quite cross.
Yeah, I think we get that.
Yeah.
We can feel it radiating from you. Yeah,
but,
good.
I mean, if I can put a plea out there.
We did submit. I'm very pleased to say. Great relief.
So that's 70.
Yeah.
But, I mean, it's important that if policymakers and regulators, and we've had a massive response from the FCA, the FRC, the PRA, the alphabet soup that is our regulatory environment. But they have actually stepped up and have done a lot in the UK to respond to this growing needs. But we as an industry need to respond back, is what I'm saying. So yes, I think it's important first off that there is that correspondence with them. But yes, believe me, if you want to score brownie points, tell me that you've done it.
Okay.
I would just say, getting involved in public policy is really not that complicated. There are organisations that you can join. You've got Rachel from the Institutional Investors Group on climate change. They do a fantastic job trying to influence policy on climate change. And signing up to the Global Investor Statement on Climate Change takes 2 minutes and whatever sign-offs you need. It's really not hard, but it can have a huge impact. Really, how hard is it to say that you want nationally determined contributions to the Paris Agreement to be improved, you want carbon to be priced? These are very basic asks, but the financial community needs to use its muscle to argue for policy that addresses these long-term sustainability challenges.
Yeah, it's a way to differentiate yourself. It may be hard because it has to go all the way to the top. And if there are some sort of barriers there, so you'll definitely find those barriers. But that will help to differentiate then. Is there that's all in that action?
Because asset owners, it's a way in which asset owners can kind of understand the character of the managers that they're providing. It's kind of, it really helps with that kind of relationship with the manager when you know what's important to them, what they stand for. And, you've got Mark Lewis here from BNP Paribas. They've I've got no commercial relationship there, but they've made great strides recently in terms of what they're doing on sustainability, what they stand for. I think this is a kind of positive thing that you want to see from the industry.
One of the areas that we do evaluate is actually what we actually use environmental social governance criteria when looking actually at the asset management firm itself. So what have you done around your human capital? What are your policies in place around some of these areas? So actually use that lens and then actually place it and look at yourselves in terms of the firms that you work with, because we do look at that and look at your diversity and inclusion policies and such like. And this sort of public policy kind of, has the management stepped in and not been able to declare support for a Paris Agreement seems absolutely nuts to me that this is something that the governments have signed off with, well, except one, but across the globe, and yet the companies don't feel that they can. I think it's just not acceptable, I think. So we need to, it does
well, we've got a few questions from the audience on the sort of assessment of managers. And one, Tomi, is for you, which is, do you look at the fund level or the organisation level? And then, Fiona, the Faith, sorry, I did say Fiona here. Faith, can you expand on why you're more forgiving of value and quant managers? But let's start with Tomi on...
Yes, very important point. So, for example, there's been discussion about PRI. PRI gives the scores at an organizational level. So we look at the strategy. So every strategy is scored or assessed by an analyst, research analyst, 200 of them at the moment, within the context of that specific asset class. So it's really understood then how ESG works within that asset class. So we are not giving that sort of organizational ESG brand scores. And hence, for example, if you look at PRI, sometimes you get really high scores sort of at the sort of brand level, but you have to be really careful then and figure out what does it mean for that specific strategy.
Thank you. Faith, sorry. You had the question to you about why you were more forgiving of value and quant managers, because I think you mentioned that at the very beginning.
I don't think I'm more forgiving. I think just the bar is currently lower. So basically, it's more a case of the fact that there is more work to be done, so therefore there's more potential in some of those spaces. It is more challenging. There are some sort of fundamental challenges with in some of those strategies. I say partly because like a quantitative one where some of these factors are quite difficult to actually distill to a number, so that makes it sometimes a bit harder for sort of an algorithmic approach to function in quite that way. But so it's more a case of just we've got an open door to kind of work with managers in that space because it's less developed. A very highly concentrated fundamental equity manager, well, I'm pretty much expecting you to already know what you're doing because this is an area where there's been a lot in that space. So therefore, there's a lot more competition in that space and the quality is generally higher. That tends to be where you'll get more of your ones within the equity space naturally. So therefore, I feel as if we shouldn't really have to work as hard with those managers, but open to working with in these sort of other asset sort of factors, as it were. But it's not that we will go easy on them, but just that we recognise this. We still need to work cooperatively to make progress.
Thank you. And Edward, there's a sort of question that we've touched on a little bit, but sort of thinking about it a bit more specifically, the question is that you note the importance of engagement. What are you looking for from asset managers to prove that their engagement activity is meaningful and not just box ticking? If you could sort of illustrate that with an example, I think that would be helpful.
Yeah, I mean, I think it's good to have kind of stories of looking at engagement in depth and what's been achieved. So I think case studies are most effective and can kind of then support dialogue with the manager in terms of understanding that engagement experience. So I think, we also like to see managers that are kind of undertaking thematic engagement, so that they look at issues that are important across the portfolio and where kind of systematic progress needs to be made. So I think that's also very useful to have a kind of sense of what particular themes the manager is pursuing and thinks is important, and how it's making progress.
Can I ask a sort of a broader question, which is around passive management and whether sort of real sustainable or responsible investment is possible through sort of passive investing? Because that's something that has been discussed and talked about a little bit today, and I'd be interested in the sort of client perspective on that.
Well, yes, certainly from a stewardship perspective, I think we've got some quite active stewardship examples within the passive community. Obviously, they recognise that they need to cover such a larger proportion of the market, and obviously that very much plays to kind of the stability of the market as well, I think. And often you get the large passive managers are particularly active in the public policy debate, because you can see why, because it's impacting on all of their holdings. We talk about passive, but actually, to what benchmark and the selection of benchmarks, that then can lead you to a whole different question, because there's quite a lot of activity in those. And you have examples like LGIM's Future World Fund, where they have essentially an index approach, but then they take some quite sort of rigid approach, in a good way, to their expectations around climate change. After a number of years of engagement, they will then sort of basically kick out constituents of that index, because unless they respond. But those constituents can come back in again if they subsequently respond to those engagements. So I think it won't be surprised that in the future that we'll have a few things around passive. One is probably more examples of that index construction having those elements as part of it. I think also with the EU taxonomy and some of the disclosures and transparency that will need to come around these benchmarks, so that we actually understand what are the implications of passively investing in some of these benchmarks. As we understand it, that a standard sort of global benchmark is actually, if you were to carbon footprint that and project that forward, you're looking at a sort of 4 degree trajectory for just of a standard benchmark. So that's quite contrary, if you like, to some of the aspirations we have around 2 degrees. So we recognise that there is some quite big challenges around passive investing, I think particularly around the sort of market failings around carbon, which is one of the reasons why carbon price is such a fundamental ask around the policy, because that will then make some of those adjustments play through the economics.
I just think, passive investment is very well suited to stewardship. It's the main way that you can add value to clients. If you're one of the large passive managers, you've got very significant positions in companies and can influence their governance. You've got a very strong interest in public policy and the overall framework for the economy being right. We've got a strong conviction in active management, so we're doing less and less in passive, but again, I like the example of the Legal and General Investment Management Future World Fund. I think that's an intelligent use of passive. But what I really like there is how there's a linkage to their wider funds as well, where if companies are ejected from the Future World funds, then LGIM vote against the chairman of the company across all their funds, across all, trillion sterling, whatever it is. I think, that's a very kind of smart expression of climate policy. And I think just being prepared to speak out is important from passive managers, because they do tend to be, they're the largest managers, they've got the biggest positions in companies. So when they speak out, if they're prepared to attend an AGM, it has import, they have voice, and it's good when managers use that voice.
Actually, one of the other questions that we have is that is the sort of direction that we're moving in, where ESG and sustainability becomes very much more important, does that favour larger institutional firms, and is that going to ratchet up the sort of the consolidation of the investment management sector? Tomi, maybe that's one for you.
Yeah, I was sort of thinking from that perspective. So, because obviously our client base is also the quite a few of the small asset owners, and for example, engagement there it's something that you can take this active sort of position in engagement, really understand where you engage. But then when you're a small firm of, I don't know, 200 million, 300 million, you have trustees around the table thinking about these issues. It is really, engagement then becomes what managers do for you, and really understanding that might be difficult. So obviously smaller firms can do that, or smaller firms, small asset owners. But I guess engagement there, and I often sort of put it in a frame of like, that's a way of having a skin in the game from trustees, understanding what's going on in the responsible investment, understanding what energy transition means. And it's then through organizations like yours being able to sort of connect to that dialogue, and that's really, really useful.
I think it's biting off what you can chew, really. If you're a smaller asset manager, then I would expect you to have a smaller group of companies for which you know really well. I would say that some of the strongest performers are actually smaller managers. So I wouldn't say that necessarily you have to be big to be good at this in any I think that's a misnomer. I think you do need to have the appropriate resources for the size of assets that you're trying to manage with this risk. Those direct, if you've got a large diversified portfolio, then you're going to need a different resource base to do that off, unless if you only own 20, 30 stocks and you're planning to hold those for 5, 10 years, you can have a very different model and resources around that. So I think it's making sure that it's fit for purpose, really, I think, and I don't think we would have a view that that biases one way or the other, but just...
Yeah, we will always be there for smaller managers. We like boutique managers, with good alignment of interest with investors. And actually we find that, we can work successfully with them on ESG issues because we may be kind of, one of their larger investors. So no, there will always be a role for smaller managers. And the risk with larger ones is that actually what you're getting is more marketing than substance as well.
Very good. The slightly different question, which is that a lot of the responsibility for progress in this field has fallen on the shoulders of asset owners. And I was going to ask you how much further you think the asset owner community can be pushed to advance change or the addressing of the climate challenge and the sustainable development goals, or really has the asset owner community sort of reached the extent of its powers, and what would you need to see from policymakers, given that we've got a sort of a session on policy coming up after this? What would you like to see from policymakers as a sort of a next step that would actually change the sort of the operating environment?
I think there is a lot of weight that's put on asset owners' shoulders to bear. They are usually the most resource constrained across the sort of investment industry. I do challenge whether that's appropriate and encourage employers, sponsors to actually think about the resources that they give to their pension funds or endowments in managing these issues. I do think more resources would be welcome. At the same time, do look to the asset management industry not to have to wait to be asked to actually perform and essentially do your job, in my view, as it should be done. One of the questions that kind of frustrates us most is when we get, well, you tell us what it is that bothers you, and what are the risks you want to manage, and we'll report to them. It's like, no, you're not really getting it. I want to know how you're seeing the world and how your investment process, what are the natural outputs from your system and your investment process that you can tell me about what's going on. That's what I want reported to me. And really very much should be more of a push from the asset management industry and make it easy for the asset owner to really understand what's going on in their portfolios. One of the initiatives that you mentioned, the Transition Pathway Initiative, that I co-chair, and Edward is heavily involved in that with the NIBs at the Church of England, was very much designed with that empowering asset owners, because we felt that what was obvious is that they are very resource constrained, but they need to be more intelligent clients. So they do need to ask more intelligent questions, but we do as an industry need to empower and equip them to do that more effectively, and TPI was designed very much for that purpose, to ask them really distill the information so it's really easy for a chair of trustees, just to be able to then ask some tricky questions around why they might hold such and such, or why this company hadn't disclosed even acknowledged that climate change was even a business risk, even though it's one of the highest capped companies in a very carbon intense sector. So I think we have to do more within the industry to equip and enable those asset owners to ask more intelligent questions, and I would challenge that the investment managers need to do more just to help their clients. Don't wait to be asked.
Yeah, I mean, I think Faith, you've been quite modest. I think you've done a huge amount to kind of mobilise asset owners, in this country. And I mean, one thing that we're both involved in is the UK sort of responsible investment roundtable of asset owners. And I think, the way in which that has grown in recent years, has really, I think it just speaks to the growing interest in ESG amongst asset owners. I mean, I remember, our last sort of get together at an asset manager, and there was kind of someone from the kind of client relations side. And when he realised who was in the room, it was like, wow, this is the creme de la creme of the UK asset owner community. So, the asset owners are here to stay in terms of asking for more on this issue.
Tomi, any comment on that?
Yeah, for example, COP26 coming along, so I guess this time could be well spent in sort of normalising the transition. That it is a conversation for asset owners, it's shared with the asset managers, and that conversation is around that. It is a very climate-related issue, but then everybody's brains start to work around that issue.
Oh, great. Well, I think our next panel is there's a natural segue there into that. So rather than take a sort of a final question from the audience, what I'd like to do is to invite Ben to come up, and Ben will in a moment introduce the rest of his panel, but just for the moment, if you could join me in thanking Faith and Edward and Tomi for a great presentation.